Don, Plato has a very successful shares income fund. Could you tell me about the objectives of the Plato Australian Shares Income Fund?
Yes, well that's where I think we're a bit different to many funds. We have dual objectives, both to one, beat the benchmark, so outperform the market, but also deliver high yield along the way. And it's aiming for around 3% more income than the market when you include franking credits in that. So it translates to around 9% income after fees.
And it's designed for particularly low tax rate investors, is that?
Yes, that's true, and that's another feature of the fund. It's actually designed for pensioners, so who are tax-free but get the full refund of franking credits. So it's trying to maximise those opportunities for pensioners, who of course need to live off that income.
And how's it performed since you started this fund up?
It's been a solid performance, outperformed the benchmark after fees since inception and delivered on its income objectives.
How does someone go about investing?
Well, it's a managed fund. They can invest directly into it. They can invest via platforms. Minimum investment's $30,000, or you can even buy it on an M fund, actually.
Don, Plato's a professional manager, you're an active investor. What are some of the pitfalls that people like I fall into when looking at dividend yield when thinking about stocks?
Well, I think the most key issue that you've got to get right, or thing to avoid, is what do we call the dividend traps. You don't necessarily want to go out and buy the stock with the highest yield in the market, because often, if a stock paid a big dividend last year, but its share price might have fallen in half, it's going to be trading on a very high yield, but it's probably the stock you want to avoid. So, looking at the highest yield stock is not necessarily where you're going to get the best income. What you want to do is buy stocks with sustainable income. And if anything, avoid the dividend traps, because you can have, in domestic sense, people might remember Metcash, came out last year and announced it wouldn't pay a dividend for 18 months. And so it was trading on about a 10% yield before it made that announcement. So a lot of investors might say, yeah, let's go and buy that stock, it looks cheap. But obviously it's not very cheap if it comes out and says, I'm not going to pay any dividend at all. Share price falls about another 30%. You get zero income and you've lost 30% capital. So avoiding those dividend traps, I think, is a key to dividend or yield investing.
That's it from this edition of the Switzer Income Masterclass on the hunt for yield. I'm Paul Ricardo.